Hi everyone, hope you're doing well. Welcome to this video on YouTube on the two stocks I'm buying, two new UK stocks I've been buying. Apologies for the break in videos. I've not done a video, I think, for 4 days now. I decided to just take a bit of a break, a bit burnt out, I think, from all the content I've been doing, and I thought, you know what, I'm going to have a couple of days off. So yeah, I had a couple of days off. What I'll do is I'll go through two new UK stocks I've been buying. Started buying these about 3 weeks ago in my portfolio. Obviously, you guys on the Patreon know about this, so if you do want to know what I'm doing in real time, place to be is on the Patreon. I also post 2 exclusive videos a week on there. And yesterday, I actually did post a video on Future on the stock request, so members of the Patreon vote for me to take a look at a stock, and Future was the winner, which was a really interesting one actually. I am actually considering maybe buying a position in that as soon as there's one thing I don't like with it, and once I kind of see where that situation goes, could be a new one into the portfolio, so we'll see what happens there. But the two new UK stocks I'm buying are interest rate sensitive stocks. So I'm believing that interest rates are coming down. Now, it's a topic for a different day. I've covered it multiple times on YouTube. I personally don't think interest rates should be coming down, but they are, and interest rates are going have just been cut from 4.5 to 4.25. So with this happening at the moment, all these people that are wanting to go buy a lot of these like properties, they're getting the properties a lot cheaper, and there's a lot of pent up demand, and it looks like there's potentially the talk about more interest rates coming. Like I said, I personally don't think it should be coming, because you look at inflation, true inflation's at 4%, which is it's doubled up in the last couple of months under this current government that we have in power, which obviously was always going to happen. Called that out multiple times, but I don't think it should be cutting interest rates. But Bank of England, they clearly are, and because of that, I think that we'll see this pent up demand in the property space actually start kicking in. In fact, we're already seeing it in. If you go look at Forterra, the brick maker, they have seen revenue jump massively. So they saw a 22% rise, and it was down to increased demand by house builders, but repair and maintenance market remained subdued. So this is the first sign. Brick makers, brick builders, all the house builders, they're saying, okay, we've seen a bit of demand, we're going to order more bricks. It's the first sign. One of the first kind of recovery signs in the housing market is when brick sales start going up, because to build the houses, the first thing you kind of need is the concrete base and then the bricks, and right now we're seeing the bricks increase at the moment. So that would say to me that towards, later 6-12 months down the line, we'll start seeing some of the house sales start coming through, house sales increasing. We'll see like the windows, because obviously windows are normally one of the last things that go into a lot of these properties, and you can kind of see here that I'm kind of projecting that like 12 months down the line, these stocks are now set to rebound, as we kind of see some of the rebound coming in through the demand with the interest rate cut coming in and the bricks coming up. First one was Taylor Wimpey. So I bought another house builder. I currently have Barrett Red Road, but I wanted to get another one. Decided Taylor Wimpey was the next best one in my opinion. The reason why is because the stock has recently had a bit of a pullback. We hit the lows in 2022 when the big inflation, big spike happened. It rallied up a good amount, 43%. And then about September, October time, probably due to the new government coming in, there's the fears around the UK market, and really pushed the stock, at one point down back 37%, or right now even 20% down. So it's not even too bad at the moment. So all the optimism about the housing market recovery for me looks like I look at Taylor Wimpey, and it's kind of all been, priced out at the moment, to be fair. Looking at the last update, they look like mostly what they're expecting this year still to be in line at the moment. And you look at, if they do get to the numbers they're expecting to do, that's around about 13 times earnings. That's on 308 million. If we get somewhere close to what they were doing even before the COVID times, which was 674 million or 500 million, you're talking about nearly doubling up of the profit there. It's going to put Taylor Wimpey down towards 6 times earnings. Not too bad for a house builder. And obviously, one of the big things that you look at with a stock like Taylor Wimpey is the dividend as well. You are going to be collecting a lovely dividend here. What it goes to, we'll see exactly. Used to be around about a 10% yield. Right now, I think it's currently like a 8% yield. So I don't even need the share price really to do that much, to be fair, while collecting 8% dividend yield. I'm getting nearly the S&P's return there. Then obviously, if we do kind of see the rebound in the house prices or the share price, back up to that £1.50 range, £1.60 range in 2-3 years' time. I think 2-3 years' time, housing market will have recovered. Give me a 30-40% jump in the share price, collect an 8% dividend yield on the way. I think it'll be really nice. And a lot of these stocks, when you look at the these Taylor, a lot of these house builders, like the balance sheets are just absolutely crazy good. There's hardly any debt on there really. And they sit on 600 and 57 million of cash. And you look at the equity, they're sitting on around about 4.4 billion of equity to a 4.2 billion market cap, which is incredible. Ownership wise as well, just that little bit of confidence sign as well coming in. The CFO came in and bought 50k worth of shares on the 3rd of March as well, which was about the time where this stock, actually it was about, where's the 3rd of March here? Yeah, about here. So very close to where the share price is right now. So yeah, I bought a little bit of Taylor Wimpey just to get a little bit more new build house builder coverage in here. The next one was Eurocell. I bought back into Eurocell. I owned this previously. I sold out because the management team seems a bit nervous around the guide, but looking at the moment, there still seems to be going in the right direction. And I thought, you know what, I'm going to buy. I'm going to buy back into Eurocell because I look at the valuation, the growth plans they have, and if they get close to this, like this stock should do really well. Important as well, another dividend yield here. You're getting around about 4% dividend yield, which is obviously really nice. Even on what has been a poor year with the interest rates not coming in previously that were expected. They've just come off a year where revenue was down 2%, but they were still able to increase the adjusted profit before tax up 32%, which is obviously, really, really good. And that led them taking up their dividend by 10% as well. They do have 5-year ambitions to get to 50 million sales and 50 million operating profit. Just put it into context right now, if we look at 2025 numbers, that's about 400 million. So a decent increase from where they're at right now. And obviously if they're able to get that profitability up to them sort of levels, it's a big increase. It's that profit's growing faster than what they're currently doing, revenue growth, and that will means margin expansion. And you can see that on the analyst numbers. You can see here like the profit growth is expected to grow faster than the revenue growth because the margins are also expected to expand. And that's how the P looks incredibly low because right now it's an 8 times earnings. But because if the profit scales up, it's a 6 times earnings company. 6 times earnings company for a company that's grown, if they're targeting, good 7, 8, 9% growth a year. It's pretty good value for me, and obviously it should lead to more hikes up of the dividend going on as well. How they're going to achieve that is they are looking to open up new branches. These are some of the new branches that they've currently got in place. A couple of other things at the moment is when you look at the growth opportunity is they are looking to increase their sales of windows and doors. You can see here the big increase from they're at 27 million at the moment, and then a big increase to 42 million, and then 59 million at the moment. The reason why is because they've got a lot of spare capacity. So what they did is they installed like a new shelving rack which gave them more basically capacity to. So at the moment they're currently selling 1,100 frames per week, but they have the space to sell 6,300. So you imagine if you're selling 6,300 but your costs aren't really changing because you've got the capacity to do it. That's where your margin expansion happens, and that's where as the scale of efficiency, that's where that should really start kicking in really overall. Another thing they're looking to do is really get onto the extension part of it. So they've been like windows and doors, but they've really started to going from this kind of conservatory conversion to a lot of people getting these, like, we're calling it more like the more modern one, which is like warm rooms where it's these like sliding doors, the nice windows, and as well as that this extended living. And you can see here that like they launched this in Q4 2023, and you can see here like the sales went from 2023 to 0.1 million to now they've 10x that to 1 million already. And you can see here this outdoor living as well, that doubled up as well last year, and they're trying to get that up to 30 million. So that's a big way that they're looking to grow the business, and also that comes from one of the acquisitions that they've made as well. But yeah, if they're able to get the growth they're expecting with the scale of efficiency, the net profit goes up as well faster than revenue growth. 6 times earnings, 4% dividend yield. I like it. I really do like it. So yeah, I've been buying that one as well in anticipation that we are hopefully towards the bottom of the housing cycle, and we start recovering, and I wanted more exposure in here. And those are the 2 stocks that I did bought into the space to try and give me that exposure. And 2 stocks I think are good value. I think Tailwind was a good value, and you get a lovely dividend. Eurocell is, I think if they do get to 2026 numbers at 6 times earnings, nice 4% dividend yield, and grows at the rate it is doing, I'd expect it to re-rate. I'd expect it to kind of re-rate to that kind of maybe 13, 14 times earnings, and obviously doubling up on a P ratio would be, double up on the share price really. So yeah, I bought them two stocks to get more exposure into the construction space, especially the building space in the UK. Hope you enjoyed it. Don't know if any of you guys are getting a little bit more exposure in this space as well, as the rebound looks to be happening at the moment. Let me know what you're interested in. I know a few of you guys are, a bit similar, like the Taylor Wimpey about Red Rose. I know some of you guys are playing the Vistrais, the persimmons. But yeah, let me know if there's any that taking your eye at the moment. But hope you enjoyed the first video back for a couple of days. Thanks for watching. Hit the like button, and maybe see you on the Patreon as well. And yeah, I'll see you tomorrow.